everyone for coming here today. My name is Adam Scully Power. I have been in this industry for, dare I say, almost 30 years. I've had a good opportunity to help build the retirement business up 20 years ago. I was head of product for a very large asset management firm and built out model portfolios for all of the biggest firms. I helped build out investment solutions. And I had the most interesting question in almost 25 years asked to me Monday night in the car with my 17-year-old son. I told him I was going on a business trip. I had to present at an upcoming conference. And he said, "What are you presenting on?" And I said, at a very high level, I'm presenting on goals-based investing. And he stopped and he paused, and then he looked at me and he said, "Isn't all investing goals-based?" And I looked back at him and I said, "You would think so, but actually that's not how the industry is currently built." I believe that we as an industry need to evolve. We need to up our game to deliver what clients are expecting, and that is truly goals-based investing. And what we're going to talk about today is the existing framework, and I'm going to introduce you to some tools that is going to allow you to deliver on that goal and expectation. Now, to get started, I have a very simple question. If I were to ask you on a scale of 1 to 100, how important asset allocation is to determining and delivering client outcomes, what would you say? 75. 100, 90, 96, 95, 95, 70, 91. We could go around the room. I don't care what audience, where I am in the country, when I ask that question, the answer is always extremely high. We have surveyed hundreds and hundreds and hundreds of advisors, and the average score that we get on that question is 90. 4 out of 5 advisors tell us that asset allocation is one of the most critical elements in delivering and determining client outcomes. Both the academics and professionals all agree that asset allocation is one of the single biggest variables to determining client outcomes. Now, we can argue as to exactly what the right number is. The Brinson study said 92%. We can go and look at all of those others. But would you agree with me that asset allocation is important? Right? Yeah. We all agree. So the question then becomes, how do we determine asset allocation for the clients that we serve? Now I'll get just slightly geeky for a second. This industry is basically built on a framework known as modern portfolio theory, which is simply to say we have different asset classes, let's just say stocks and bonds, and what we can do is we can build a nice, efficient frontier, and the framework of modern portfolio is driven by risk and return. For a certain level of expected return, we have to tolerate a certain amount of risk. But the main driver in this becomes risk. And what happens is we sit down with clients, we understand their hopes, their dreams, their desires, their goals, and then we have to ask them, how much can you lose before you lose sleep at night? What is the maximum loss threshold that you can, quote, tolerate? And we could ask a client that question. Let's just say arbitrarily they said 30%. We simply go 30%. We have a volatility characteristic. We get mapped into a 60-40 portfolio. And that's how asset allocation, by and large, is determined. By a singular dimension, which is how much can you lose before you lose sleep at night. Now, the follow-up to that is, how do we determine how much somebody can lose before they lose sleep at night? What do we give them? What is the test or questionnaire that we always give them? Say it together. Risk tolerance questionnaire. We ask them a whole series of questions. Some have more, some have less. We ask them lots of different ways, but it ultimately gets to the same thing. How much can you lose before you lose sleep at night? We then give them a score. We group them together into this big mass of conservative or moderate or aggressive, and then we take that and we simply map it to one of 5 pre-built standard models. The industry, by and large, and I don't mean to oversimplify, is risk score to Model 3. Now, there's nothing wrong per se with that inherently. It's a very simple framework. It allows us to run our practices efficiently. It allows us to group clients together and get them into an asset allocation. But what is not inherently incorporated in risk tolerance questionnaires? Everything that matters. Your time horizon, your cash flows, your savings rates. I can go through here. Here's two simple examples. Two clients, vastly different ages, vastly different account values, vastly different savings rates. They have different withdrawal desires in retirement. Yet if they take the risk tolerance questionnaire and they answer it the same way, guess what happens? They get put in what? The exact same portfolio. And so we ask advisors, and what they tell us anonymously is that 90% of our clients are sitting in our moderate model. And we know that's not the right answer. The other challenge that we see when it comes to risk tolerance is basically where in the market cycle you are determines on how you answer the questions. It's massively behaviorally driven. If you've been in a 5-year running bull market, people go, yeah, I can lose a ton of money. But if you ask that same question in the depths of a financial crisis, how do you think they answer? Or what side of the bed they got up on the morning, they might answer differently. So your risk tolerance, which simply is how much can you lose before you lose sleep at night, gets driven behaviorally by where you are. Now, how many of you, just quick show of hands, use a risk tolerance questionnaire? Show of hands? All of us, right? Because we have to do suitability. How often do you do it? Every year? Or is it more one and done? It tends to be more one and done. The other challenge with risk tolerance is once you set it, we tend to do this. We go risk score to model 3, and then every year we just say what? Let's rebalance back to our static weight, regardless of where we are in the market cycle. God forbid we happen to ask that question down here where you get a low score, and boom, we're in the same portfolio. Again, the question is, can we improve and can we do better than that? We have asked, again, advisors after advisors after advisors, this question, right? Do you believe that the standard risk tolerance questionnaires adequately capture a client's true risk preferences? Do you think this is a big number or a small number? Hundreds and hundreds of advisors say this, 96% say no. By the way, there is no question in this industry where 96% of advisors all agree on something. We ask a second follow-up question is, do you think risk score should be the main factor in determining a client's asset allocation? Answer, 87% say no. So here's the thing that I find interesting. We have built the industry on a framework of risk tolerance being the primary driver to asset allocation. We all sort of operate under that framework because it covers suitability, and yet we all agree that it's not the ideal thing. And the question then is, why do we still do it? Because the real answer is to deliver truly goals-based investing is hard, and it is complex, and it requires new tools and solutions to actually deliver a better outcome for investors. And the framework to do that is this concept known as wealth optimization. It's a very fancy word, but what it ultimately means is how do we integrate a client's unique goals, objectives, aspirations through a financial plan? How do we incorporate real-time market analysis? What's going on in the world? Where do we think forward-looking expected returns can be? And then can we integrate this framework of wealth optimization, which is to say, can we build portfolios today and at every point over a client's time horizon to maximize the likelihood that they have the wealth, the dollars, the money they need to satisfy the goals they have in their plan? It's that simple. Wealth optimization is all about, to the asset owner, are you going to have what you need when you need it? Now, what does wealth optimization do? Number one, it directly connects to a client's goals and objectives. And ultimately, what every client is looking for is that. I want to know that you understand my goals, and I want you to build a portfolio that's going to maximize my financial success to accomplish and reach those goals. Number two, we have to think about risk more comprehensively. Risk cannot simply be volatility or how much can I lose before I lose sleep at night. Risk has to be not having what you need when you need it in the future. That's ultimately what clients determine risk to be. Number three is to do this because markets are dynamic and clients' lives are dynamic. It cannot be static. If a client's goals change, their portfolio should change accordingly. If market conditions change, we should account for that in real time in what the optimal mix should be. And lastly, when you actually move to goals-based investing and truly deliver on it, you have far greater conversations with clients. They trust the process. They have more confidence in the plan. And the dirty little secret in the firms that we work with, and we're working with so many now, is the advisors tell us, it gives me, the advisor, more trust and confidence in the recommendations I'm actually delivering for clients. So I'll take 2 seconds just to describe quickly who we are here. We're a little firm called Nebo Wealth. For 10 years, we've been building out this wealth optimization process, and 2 years ago, we launched it and made it available for advisory firms. We won an Industry Disruptor Award right off the bat. We've been voted the best goals-based investment platform 2 years in a row. So the industry is taking note. Folks around the industry like to write about us. Now, I would not say this for ourselves. We were called the holy grail of portfolio management. I'm happy to read it on a slide. Bob Veras is very well respected. We had Dados actually came out the other day, called us one of the best optimization engines out there. Cerulli named us out as someone to look for. So we're winning all these accolades. People are starting to take note. And the reason that is because we think we have a very good tool, but ultimately, you as advisors care about your clients and you want to deliver more goals-based investment management. So I'm going to just spend a second to talk you through, what does this process actually look like? Number one, to do wealth optimization, we have to take in client information. We need to know what their goals and objectives actually are. We have to account for their time horizon, how far away they have from their goals. We need to make sure we understand their liquidity needs. Notice that risk tolerance is part of this equation. We don't throw it out the window. We want to incorporate it into the optimization. We have to account for cash flows and we have to account for their current assets and legacy goals. Risk tolerance is important, but it's not the only variable. How many of you here do financial planning of some sort? Show of hands. Right? You do the cash flows of those clients. You probably use one of those names up there. They do a very, very good job of cash flow analysis. We want to take that detailed cash flow analysis, the dedicated work you do on the planning, and we want to incorporate that into the Nebo Wealth process. Because now we're delivering more personalized recommendations for the clients. Once we have all of this, what we then do is first calculate what the minimum required return is needed for that client to achieve their goals. When you actually go and study the CFA curriculum to build portfolios, one of the things they tell you you have to have is, what is the minimum required return? How many of you, show of hands, actually calculate that? We see a few hands. Congratulations, right? This is what we do. We start with this. Now, wealth optimization is not based just on the return. What we then do is we take that return and we project forward what the target wealth needs to be for that client at every single point over their time horizon. And what wealth optimization does is to say, if we know the minimum required return, and we know all the details about the client, and we project forward that wealth path, what we then want to do is run this sophisticated optimization to say, what is the optimal asset allocation, the optimal portfolio mix that that client should have in order to minimize the risk that their wealth, their money, their dollars falls into the red zone. What do clients care about? Am I going to have the dollars, the wealth, the money I need when I need it? That is ultimately what wealth optimization is. And the unique thing about what we do at Nebo Wealth is that this pie chart, this optimal mix, can be any asset class that you like and implement it any way that you want. We are a completely open architecture solution. The reason why most RIA firms don't go to outsource models is they can't customize the individual client needs, they can't customize the asset classes, and they can't customize the implementation. They have to take the off-the-shelf model or not. With us, you can have any asset class that you like to use in your investment philosophy. Your identity as a firm ultimately is in part what you choose to use here. We are agnostic. We will mold ourselves around you. We'll then optimize and build that perfect fit portfolio based on the goals, objectives of the individual client, and then you can implement that portfolio any way you want. ETFs, mutual funds, individual securities, separate accounts, we are agnostic. Our mission is to help you help clients deliver the optimal asset allocation at every single point over their financial journey. And what we'll do is it will incorporate real-time market data. So certain asset classes are expensive, certain asset classes are cheap. Every single asset class that you could choose, we have a short horizon, forward-looking expected return. We have a long-term expected return. This is just two examples. This is the S&P. This is the forward-looking expected return of the S&P 500. Sometimes it's a lot more attractive than others. This is a 10-year US Treasury. Sometimes you want to have more or less depending on where we are in the cycle. The beauty of incorporating valuations into the framework is that you're getting more robust output. And ultimately, that's what delivers better performance. And the process of wealth optimization is not set it and forget it, because markets are dynamic. Are your clients' lives dynamic? Yeah, they inherit money, they have medical conditions, things change. And so wealth optimization allows you to always align the optimal portfolio with the unique goals and objectives of the individual client and what's going on in markets today. And so here what you're looking at is nothing more than a 60-year-old client. They want to retire in 5 years. And what we've plotted is what would the allocation look like for that person at each point over this time horizon. Markets were very dynamic here. This is the blue is equity. A lot less equity at the peak, a lot more in the bottom in 2003. See the yellow in here? That's your exposure to alternatives. How many of you use alternative investments into your mix? Most of you. Can I ask a side question? Because this is something that we're bringing to market right now. How many of you use private assets? Private equity, private credit, private real estate? Show of hands. Nice and high so I can see. Okay, let me go back for a second right here. This is huge. What we are watching unfold is the democratization of private assets. We can incorporate into that optimal mix private equity, private credit, private real estate. For Mr. and Mrs. Jones, given their unique goals, objectives, aspirations, risk tolerance, cash flows, what is the optimal allocation to this space? And as more and more people are using it, the compliance aspect of this is going to become critical. Because God forbid there's a liquidity crunch, and these are illiquid instruments, and they can't get what they need, their assets. And when you're standing in front of an arbiter, you can't say 10% felt right. You need tools to be able to optimize, to determine how much you allocated to this space. By the way, how many of you work with small or mid-sized business owners? Quick show of hands. Okay. Do you ever account for their business in your portfolio design? You're shaking your head yes. It makes a huge difference. See this little thing right here, this little line, business ownership? We can literally put a sleeve in our tool. We can account for your interest in your illiquid business. And once we account for that, we can then say to you, for your liquid assets around it, what's the optimal mix? And let me tell you, the optimal mix, if you account for the business, is very different than if you don't. we don't tell you should or shouldn't do it one way or the other, but when you sit down with a business owner and you show them two options, I can assure you no other advisor is actually doing that. I present sometimes to a CEO group called Vistage. Anyone ever heard of them? You've heard of them? Someone at the end of a session, I don't talk about this, said to me, what are you working on? And I told them about this. Every single business owner came up to me afterwards and said, how do I get that? And I said, well, we don't make this available to individual clients, but we have advisors and firms that do this, and I can refer you. This little piece right here, right, is massively referable for CPA firms coming over to you. Okay, let's start to wrap things up for a second. So there's a little organization called Vanguard. Has anyone ever heard of them? They're great. They did a survey study called Advisor Alpha. Have you guys all seen this? How important are you to clients? You can't see it, might be hard. They say that the value in totality that you deliver as advisors to client outcomes is up to or even exceeds 3% in net returns. Great. You see this first line here? I highlighted it. It says suitable asset allocation. And on the far right, they say it's worth greater than 0. So asset allocation, they just say it's worth something more than 0, but they put a little asterisk next to it. So if you read down to the bottom of the thing here, it says, the value is deemed significant, but too unique to each investor to actually quantify it. How did we start this session? By talking about the importance of asset allocation in client outcomes. They validate that it's important, but they can't quantify it because everyone's goals, objectives are different. Well, we have. So we have research, we have white papers that you can go to our website and download that would suggest that if you follow this wealth optimization framework, that you incorporate market valuations and you allow for a dynamic mix of that portfolio of your time horizon, what we would suggest is you can add upwards of 100 to 150 basis points of excess return. Now, is that meaningful? Well, when you start to model out that little bit of excess return, you see this black line here? That black line is the minimum target wealth that we talked about earlier. Anything under this black line would be that red zone that we're trying to stay out of. The dark blue line is median wealth. Same 60-year-old client case study that we were looking for before. So that little bit of excess return over time actually accumulates to not only greater probability of success, but a much more significant ultimate wealth. And the blue is what I call the zone of success. I would argue that as an industry, we are moving to much more personalized investment solutions. We as humans are demanding it, from the way that we watch and consume media, to the way we order our coffee in the morning, to the way we expect our advisors to deliver investment advice to us. And what we would argue is that as an industry, we are just evolving. We are moving beyond simple tools like risk tolerance questionnaires as the primary driver. We are starting to incorporate things like wealth optimization to actually deliver on this goal of delivering more goals-based portfolios. And everything you see here is the things that we hear from the advisors that we work with. I'm looking to do more of this, right? I want stronger engagement with my clients. I need a tool that can do all of this with the touch of a button so it's scalable and efficient. If it's not scalable and efficient, I'm not going to use it. We actually find firms that do this in Excel. And we sort of secretly say, we give you permission to stop. You now have a framework. If your mission and goal is to actually deliver goals-based investment advice to clients, to do it simply, efficiently, and with scale. And by doing that, you're going to have more engaged clients. And you're going to get more referrals. And I don't just say it because this is what we do. This is what our clients, you as advisors, tell us. I'm gonna spend 60 seconds and let you hear from them.
And we feel that, today we're delivering a far more personalized portfolio with an institutional quality investment approach, and getting 2 for 1, and it really personalizes that asset allocation.
I use it every time I present it. Clients like it. Every time I run it, clients like it. Now, if I can go into a meeting with the NEBO report, with their investment reports, with some planning strategies to pursue based on everything we know, I feel better, so the meeting goes better.
For me, it's a time saver. It's a better product. Clients are more engaged. It's such a comfort to know that, yes, this is the best we can do on the proper risk for this client and their proper ability to achieve their goals.
How are we going to actually maximize the chance of hitting our goals here? And it may be very different than what your gut feel would have told you. That's what kept me up at night all the time. Like, how much stock should this be? Oh, they're willing to do this, but should they? Does that make sense? That one's good. And that's what NEBO does for you. And it's just literally, it's taken off your hands and off your shoulders. And that was kind of the success maximizing choice that you made. And that's really all you can ask for in investing in life in general.
For those of you that may be just curious or intrigued by this, we would encourage you to come and visit us. We're at booth 400 over here. There's lots of ways that you can engage and work with us. I have a couple on the screen here. So some of you are planning focused. That's your heart and passion, you love to do it. And what you can do is you can take that dedicated planning work, you can just import it into our tools, and we can build that optimal portfolio. We can incorporate the trading, the rebalancing, the billing, the performance reporting. We work with lots of different firms. We have a very strategic partnership with firms like Advizon, where it's fully integrated. So we can do fully outsourced investment management. For larger firms at enterprise level, what they're doing is they're coming to us and they're saying, hey, can we take your goals-based process and embed it into our existing work stream, have it sit under the hood, and have you guys build these optimized portfolios using our existing infrastructure, and we can do that. And when we have a huge consulting group, literally every firm that works with us, we act as your consultant. We're completely open architecture at every single level. We see the whole aspect of what's going on here, and we'll tell you kind of who works well with others, how does this actually fit together. We've all been in this business for a long time. We're investment people at heart, but I think the thing that we love more than anything is working with firms to helping them improve their process and ultimately delivering better outcomes for clients. And so what I'd ask as we close up here is, if you're just curious a touch and you'd like to learn more, you can scan this QR code. It'll take us to our website. You can read a little bit there. If you'd like to book a time to just schedule a call, we'll walk you through a demo. When you click on this, it'll literally come right to my calendar, and we'll find a time that works. And myself and our whole NEBO Wealth team, we're here under a really simple mission. We're here to elevate the industry. We're here to help you deliver better tools to ultimately help your clients. And if it resonated at all with you today, I'd very much encourage you to come right over there to booth 400, learn a little bit, we'll show you a few demos, and I thank you so much for your time today.